Most investors in the US today are asking the same question. How do I pick stocks that will actually perform for the next 5, 10, or even 20 years? The answer lies in analyzing fundamentals the right way. And in this video, I'm going to break it down step by step in simple language, so you can start building a strong long-term portfolio today. Hey everyone, welcome back to StockWisp, your trusted guide to smart investing strategies. If you're new here, I simplify complex financial concepts, so make sure to hit subscribe and turn on the bell so you don't miss actionable investing content designed for you. Section 1. Why fundamentals matter in 2025. Right now, in 2025, the U.S. stock market is at an interesting crossroads. We have tech giants dominating headlines, interest rates still higher than pre-pandemic levels, and investors worried about whether a slowdown is coming. In times like this, fundamental analysis is your safety net. It helps you separate hype from reality and choose companies that can actually survive and grow long-term. Section 2. The 4 key fundamentals to check. To analyze any stock for long-term investing, focus on 4 main fundamentals. Revenue and earnings growth. Look at whether the company is consistently growing its revenue and profits. U.S. investors should especially watch quarterly earnings reports. Are sales growing year after year? Debt levels. In today's interest rate environment, companies carrying too much debt can struggle. A safe long-term stock usually keeps its debt under control compared to its earnings. Profit margins. Strong companies maintain healthy profit margins even when the economy slows. That shows they can survive recessions and still reward shareholders. Valuation ratios. Don't overpay. A good business bought at a bad price can still be a bad investment. Compare the stock's P/E ratio with its industry average. Section 3. Applying fundamentals to real U.S. examples. Let's take 2 quick examples. A steady dividend company like Johnson & Johnson, moderate growth but stable cash flows and low debt. A growth stock like Nvidia, rapid revenue growth but higher valuation. Both can be part of a long-term portfolio. The key is understanding which fundamentals make them strong and how much risk you are willing to take. Section 4. How you can use this today. So how do you apply this? Read quarterly earnings reports. Compare debt-to-equity ratios. Track profit margins over the last 5 years. Always check valuation before buying. By following these steps, you'll avoid emotional investing and start building steady wealth. Remember, long-term investing isn't about chasing hype. It's about discipline and sticking to fundamentals. If you found this breakdown helpful, hit the like button and subscribe to StockWisp for more simple, honest investing guides. And let me know in the comments,